Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. There has been a groundswell of activism in the Facebook discussion group. We've been hitting membership requests at a level we haven't seen before. It's free to join, so everyone can come and join. But a lot of that groundswell has been driven by a request that's been made of you to reveal your portfolio.
Okay.
So as we kick off today's episode, let me put it to you. Will you give the community what they want?
If the numbers are there...
we've already passed the...
Oh, have we?
Yeah.
Okay.
Well past.
Well, I'll give the people what they want.
Today?
Not today.
Okay.
We'll let it sizzle for one episode longer, Ren. You led the way. You revealed yours last week after some groundswell in the community. And so, yes, I will. I'll follow suit.
I was nervous. I'll tell you what, the night before the episode was released, I was worried, what the backlash would be.
No backlash.
It was okay.
Yeah, everyone's loving it.
Anyway, we're not going to be talking about that today. So what are we going to cover in today's episode?
All right. Well, we've got a community question that's come in around capital gains tax and how to think about it at tax time. We'll be closing out with some investor confessions that have come through from the community. Love it. Keep them coming. But as always, we will be starting with news and views.
News and markets.
Now, the biggest non-story to kick us off, the Reserve Bank of Australia met this week in the context of Canada having cut rates 3 times, the US doing a double cut of rates, the UK cutting rates once or at least once, the EU's cut rates, China cut rates. So the RBA met and...
No rate cut.
No rate cuts. That's right. They left the cash rate on hold at 4.35%.
Yes.
Unsurprising.
Yeah, the RBA have said that policy will need to be sufficiently restrictive until the board is confident that inflation is moving sustainably towards the target range. To make that clear, they're going to keep rates where they are until inflation gets back to that 2 to 3%.
Yeah. Now, core inflation, so excluding energy and food prices, inflation for the 12 months to July was 3.7%. And they want to get it back under 3% before they think about cutting rates. So I don't think there's much more that needs to be said. Interest rates and inflation has been spoken about too much. Well, it's definitely been the biggest story, but we've covered it to death. Australia didn't move as hard as a lot of these other nations. We didn't raise as quickly or as high. The US got interest rates into the 5s. And so inflation's been slower to come down, and so we're not cutting rates as soon. And we should also acknowledge New Zealand has cut rates as well. We didn't include them in the list before. So
name a country that's not Brazil.
Argentina. Okay. I actually don't know. Turkey.
True.
So for context, between May 2022 and November 2023, the RBA raised rates 13 times in 18 months. In the 10 months that have followed since, we've just held, and it is likely we continue holding for a little while still.
You would think so. All right, well, we'll keep an eye on it and keep you updated as things progress. We've got a few headlines here that have caught our attention, all related to content that we've been speaking about on the show. And the first one is off the back of last week when we were speaking about Oracle and the demand for power for their data centers. because, well, Microsoft have come out and signed a 20-year deal with Constellation Energy to restart the 3 Mile Island nuclear power plant in Pennsylvania, which was closed in 2019 as it was losing too much money.
Yeah, the story in the US is that natural gas has made a lot of these uneconomical, like coal-fired power stations and nuclear-fired power stations, uneconomical until AI comes to town and spikes demand for energy. As you mentioned, Oracle have their data center that they're trying to power with 3 small modular reactors.
Yeah.
There is nothing small or modular about the 3 Mile Island nuclear power plant. It's massive. The name might sound familiar. It had a partial meltdown in 1979.
No idea.
It's probably America's biggest nuclear accident. Yeah, Microsoft have basically got an offtake agreement now, and if US regulators approve it, it would be reopened in 2028.
Crazy. Do yourself a favour, Google it, because as you said, Ren, it is no small feat. This is enormous. The second headline, we had Mr. Beat Up Ren come on and talk about Nike, I'm going to say a couple of months ago. They were really beaten down. I can't actually remember the reason for it, but the market was overreacting because they'd missed the running boom or whatever it was.
Yeah, so Nike have made a few strategic mistakes. They missed the running boom, like, Hoka and Asics and all of them have sort of taken market share in their core market. But also during COVID, Nike really went for this direct-to-consumer strategy, and they were like, we're going to sell online and we're going to sell first party on our own website. And fast forward a few years, and they've kind of realized that they had a lot of important relationships with third-party retailers, especially like the Foot Lockers of the world, which they've neglected.
That's right. That's right. Now, as a result, the share price was down 51% since its recent high in November 2021. But the news is that Nike's CEO, John Donahoe, has abruptly quit. Now, interestingly, Elliot Hill is the man replacing him. He has been at Nike, was at Nike since his first day of working. He was an intern. You should go and check out his LinkedIn. It's fascinating to see all the positions that he's gone through. But he actually retired and has now been brought back in after retirement to be CEO.
Yeah, I think he retired because he was passed over as CEO in 2020. But yeah, now he's back. And the brutal thing about the share market is there's no hiding from its opinion of you. When CEOs quit, new CEOs are hired. You can tell what people think by the share price. When Elliot Hill was announced as the new Nike CEO, shares jumped 7%. So that's a nice little ego boost for the new CEO.
A knife in the heart for John.
Well, I think,
Anyway.
Probably the 51% share price fall before that,
And then finally, a nice tie into what we were speaking about last week with Nick Cregan from Fairlight Asset Management and getting his view on Rightmove is that the takeover bids from REA Group continue, Ren.
Yeah, so there was a first bid, which was rejected. A second bid, which was about 20% higher than the first bid. It was about 11.5 billion Aussie. Also rejected, but REA are nothing if not persistent because we now have a third bid. REA also had a crack at Rightmove's board. They said they were, quote, genuinely disappointed at the lack of engagement by Rightmove's board.
Wow.
Which is kind of like, they don't owe you anything. They don't owe you engagement. You've got to make it compelling enough. Or have convinced enough shareholders to make it real. What I guess you don't want in this situation, and I think I can't remember, it was either BHP or Rio, but you don't want to be bidding yourself up too much. Just negotiating against yourself, basically.
You don't want to kind of, and I hope that doesn't play out. But from what we learnt last week from Nick, this is certainly a compelling business. So whether or not REA can get it at the right price, or at least even get Rightmove engaged, it doesn't even sound like that. So interesting. Yeah.
Now, if you're unfamiliar with who Rightmove and REA are, REA owns realestate.com.au, Australia's dominant real estate portal. Rightmove is the UK's dominant real estate portal. And in a previous episode on Equity Mates, which is live in the feed right now, we spoke to Fairlight Asset Management's Nick Cregan, who owned Rightmove before this all broke. So we got some interesting insight there. And if you feel that it's hard to keep up with all the episodes that we're releasing and all the news that is happening in markets around the world, well, do we have good news for you? We break it down in a very fast to read, easy to understand daily news email, get you up to speed and on the go in 5 minutes or less. Read it on the train, on the bus, however you commute, as long as you're not driving. But yeah, great way to start the day. Sign up. The link is in the show notes.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question. Your
Answered.
So today's question comes from Darcy. A reminder, if you want to submit a question, you can head to equitymates.com/contact. But let's have a listen.
Hey boys, love the show. Hey, I was wondering if you could talk about stocks and tax and how capital gains tax is calculated, whether you've held stocks for a year or not, and come tax time, how you keep a record of your winners and your losers so that next year it's not such a burden. It sounds simple when you talk about it, but when you open that MyGov app, it quickly gets confusing. Thanks.
Nice. Thank you so much for the question, Darcy. And yes, no doubt that this is a time of confusion for a lot of investors when they hit tax time, especially if it's your first time giving it a crack. So
my number one tax tip, never sell.
Yes, I was thinking that. Yeah,
You don't have to deal with it.
That's it. Don't sell, don't have to worry about it. Now, first we should start with actually how capital gains tax is calculated.
Yes.
Firstly, to Ren's point, it's only calculated if you sell. That's when you have to worry about it. And there's two elements to it. If you hold your investments for less than 12 months, it is considered a short-term gain. It is added to your assessable income and taxed at your marginal tax rate. The full capital gains that you make is added to your assessable income. If you hold it for more than 12 months, this is where you are then eligible for the 50% discount on the capital gains, which is then added to your assessable income at your marginal tax rate.
So to be clear, 50% of the gain is added to your assessable income.
Yes.
Now, for people who are not in Australia, this may be confusing because if we go over to the States, for example, there is a separate tax rate for capital gains. That is not the case in Australia. There is not like a 20% tax rate for capital gains. Rather, the gain that you make is added to your overall assessable income alongside your salary and any dividends you got paid and any rental income if you have an investment property. It all gets rolled up into your assessable income. And then the difference with capital gains is that 50% discount if you held the asset for longer than a year.
Yeah. So it really comes down to the 12-month time period. That's where you kick in the 50% discount. Now, it's up to you to record all of this information and either plug it in as you do it yourself or go through with your accountant.
Well, hold on. I think, it is up. The responsibility is on you. The good thing is with brokers these days, they have a transaction of every time you've bought and sell and the date and time you did it. Yeah. So there is that data being recorded if you're using an online broker.
Yeah. So the second part of your question, Darcy, is around how do you keep track of all of this, winners and losers, so that it doesn't become such a burden. Firstly, if you provide your tax file number to your broker platforms, it does plug into MyGov and the ATO does or can pre-fill a lot of information. Now, it's not always entirely accurate. You do need to validate it, and it doesn't necessarily cover all the transactions that you've made, but it is a good place to start. Ren, how do you go about this? If you are selling, how do you go about tracking and doing this at tax time?
So to be clear, the not selling was a joke.
Yes.
Yeah. Let's just make that very clear. So I use the information from my broker, and I also have a spreadsheet where I track everything. But honestly, like the information from my broker is enough.
Yeah. So I guess there's information in your broker, get the spreadsheet out. What you really need to be recording is just purchase date and price, and then at which point you sell it, what your sale price is.
The complexity really comes, I find, if you are choosing to, like, if you've been dollar cost averaging over time, and then you are selling portions of a holding over time, that gets complicated. Is it first in, first out? Is it last in, first out? Like all of how long did I hold each parcel for? That's when it gets complex. But I find that like I don't really trim my portfolio in that way. Like I will own, if I'm selling, it's because I don't believe in something anymore, and so then I'm selling the whole amount, and so then that's a little bit easier to do the maths on.
So a couple of platforms that I think I would certainly recommend if you want to take away some of the burden at tax time is ShareSite. I use it, highly recommend it. You do have to track during the year all of the purchases and sales that you make, but come tax time, they spit out tax reports for you that you can just use in MyGov or for your tax accountant. So yeah, it can be complex, but I think doing the work throughout the year to keep track of it is the way to go. But I think the main thing here is the capital gains tax, the 12-month period, and is not a separate rate. It is just applicable to your accessible income.
A few other tips just as we close it out. Make sure you record your capital losses as well, because they offset future gains in future years. So to explain that, we say that if you hold an asset for a year, you get that 50% discount, and so you only add 50% to your assessable income. Well, you can also add less than 50% to your assessable income if you've also claimed losses in previous years that offset some of those gains. So that's a good one to keep in mind. You mentioned ShareSite. What you didn't mention is that there's an offer for Equity Mates listeners if they want to sign up and get a discount. They can go to they can go to sharesite.com.au/equitymates.
Yes, we'll check that out. It is free to get started if you have less than 10 holdings. All right, well, we're going to take a very quick break, and on the other side, we will be back with 3 investor confessions stepping in to the confession box. So can't wait for that. We'll be right back. Welcome back to Equity Mates. We are going to jump into the confession box.
In the confession booth, everything is anonymous.
Where you guys have the opportunity to tell us your confessions, whether it's investing related, money related. I'm waiting for one that is just life related, Ren.
Okay. Now, there are multiple ways that you can confess, and I should just clarify for Bryce before we go too far, it's not the confession box.
What did I say? Box?
Yeah, it's
booth.
The confession booth. Just to save the comments. But there are multiple ways you can confess. We love it if you record a voice note. If you want us to change your voice, we can. But you can also submit a confession with your name or anonymously, and our producer Sophie will read it out. Soph, thanks for joining us again.
Hello.
Now we've got 3 confessions here. The first is a voice note, and then we've got 2 written ones. So let's kick it off with the voice note.
Forgive me, mates, for I have sinned. I purchased my dream car, or what I thought was my dream car, at 18. I had no money, I was an apprentice living at home, walked into a dealership and walked out with a $26,000 car loan over 7 years at 14% interest. 14%! I was young with really no financial education. I didn't even know what interest rates were at the time, let's be honest. I wanted the car, so I had to have the car. No ifs, ands or buts. Anyway, fast forward 7 years, I ended up paying around $46,000 for this car, which I then went on to sell 3 years later for $16,000. $30,000 down the hole because I just had to have it. What a dum-dum. Anyway, now older, somewhat financially educated, thanks to Equity Mates, I see what a silly mistake that was, and I feel like an idiot for it. Anyway, love the show. Thanks.
No one are idiots if you come on and confess in the Equity Mates booth, but thank you for the confession.
Yeah.
Jeez, the power of interest rates.
I know. 14%. It's
pretty criminal. It's pretty criminal.
It's a lot. Yeah. Well, I mean, they're not criminals, but I think the car loans are such an American thing, and they're like slowly creeping their way more and more into Australia, and it's like as much as possible. Obviously, some people need it. A specific car for work or for whatever reason, but as much as possible, just pay cash for a car. Do not go into debt for a depreciating asset. Yeah,
absolutely. Alrighty, well, we've got 2 confessions here that are centre around timing the market. So this one was written in, so thank you to the community member here. Take it away.
I first started investing in 2018 after seeing Afterpay on some websites and thinking it was a great idea. I bought Afterpay at $8.70. I wrote it up to $18 when regulation news came in and a family member warned me it could be bad, so I sold out at about $15. I think it went back up after the worries settled on regulation. However, when COVID hit, it dropped right back down to mid $9. Instead of just getting back in, I wanted to buy at $9, close to my original parcel price. But it only got to low or mid $9, so it was a lesson on trying to time the market versus just getting in the market. Then I missed out on it going all the way up to $150 in 2021. By not buying, I missed out on $20K plus, even if held until the Square buyout.
Wow.
That is brutal.
Absolute roller coaster here.
You know what, though? Like, there is another way that you could, obviously not great, the second part, but you did double your money on Afterpay.
Yeah, taking
at the
it
start
from
of that.
$8.70 to $15.
To $15.
100% return. Well, just less than 100%, but still. I think a couple of things here for me. Firstly, news on regulation that didn't eventuate, always risky making a decision when there's like news on what could come, if that makes sense. And then listening to family members. I know statistics show that so many people do listen to family and friends, but I remember that point in time in the Afterpay journey, and so many people sold out at that point in time on what was just a perceived regulatory change that really didn't eventuate. So bit of risk there.
Yeah, it's hard to say that though, because like for every example where the regulation didn't occur, I could probably think of an example where regulation did occur and it was the right move to sell. So I get that, you know, like,
fair.
I own tobacco companies in the 90s and there's rumours that they might get regulated. Like, it was the right time to sell then, although they've actually done really well since, so not a great example. You don't have to, you could have sold some and taken some money off the table, taken some risk off. But I think really the confession comes into its own when you're just anchored to an arbitrary price of $9 rather than buying when it was around $9 and the risk of regulation wasn't there. So that's where it's a common cognitive bias when you anchor to a certain price. The classic example is when you've lost money on a stock and you don't want to sell until it gets back to the price you bought at.
I do remember this time so clearly though, when COVID came, and I remember looking at the computer screen and seeing $9. I was like, oh my God.
So for people unfamiliar with Bryce's personal journey, Bryce was still working at Woolworths at this time, and he cemented himself as a legend amongst the graduate cohort at Woolworths when Afterpay was... You were first spruiking Afterpay at $2.
$2.50.
And people at Woolworths still talk about that stock pick. And Bryce became known as the Afterpay guy, and it probably legitimised equity mates in a way in the people in Woolies' mind.
Yeah, it was a good story.
You haven't had a stock pick like that since?
No way. No, that was
one hit wonder.
No, you only need a couple.
Kerry Packer had this famous line: "You only get one Alan Bond in your lifetime," and I've had mine after he absolutely fleeced him on Channel 9. Maybe your saying is you only get one Afterpay in my life, and I've had mine.
Hope not. Anyway, good one. Thank you for submitting. Now another final one here. It is a bit lengthy, but stick with us because there's a lot of lessons out of this one. Over to you, Soph.
Hi, Equity Mates. Before getting into the confession, I just want to say I do use some numbers in the following confession, not to brag or show off, but just to provide some context that I think is somewhat vital to the situation. I'm about to turn 24 years old and would say I've been investing since I was 18 or 19, but have really only started to take it more seriously within the last year. I was lucky enough to get a corporate job straight out of high school and worked full-time while studying part-time at uni. I never received any inheritance or help from my family to get to my current financial position. Over the last 5 or 6 years that I've been working full-time, I've been on roughly the same average grad pay the entire time. As a result, I'd like to think my current financial position isn't too bad. I've got no HECS debt as I paid for my uni myself each semester and have got a net worth of roughly $150K that's currently split 40-60 in stocks and cash respectively. With this background, here's my confession. Despite knowing the benefits of investing, I prefer to hold cash in a high-interest savings account. This isn't even necessarily from a risk perspective, but merely because I like seeing my cash balance in my bank account. There's something about it psychologically for me. It almost scratches an itch in my brain that's really satisfying. But there's also probably a slight risk aspect to it. Some of the stocks I've bought have been great, others not so much, e.g. most recently investing in lithium close to its peak and not selling when I made some gains. End result? Losing close to 90% of all my investments. With that, we approach my next confession. I still hesitate whenever I try to make the decision to actually invest. Whether it's index ETFs or even blue chip companies, I always seem to make the decision to invest long into a bull run. There's even a running joke in my family that if anyone wants to buy anything in the market for a lower price, they should let me know, as whenever I decide to buy, that stock generally falls almost immediately after I get the buy confirmation from my broker. As of today, I want to invest more into the market, but I keep reading news articles that the market is hot right now and every company is extremely overvalued. Even the indexes seem to be hitting new highs every other week. While I know there's no way to time the market, I still feel like I've missed out yet again on another bull run. What would you do if you were in my position?
Wow, nice. Thank you, Soph, and thank you to our anonymous community member who has just submitted that confession. A lot in there, Ray. A lot in there.
So really two big confessions. The first one is holding 60% of their money in cash.
Crikey.
And then the second confession was about not investing because they're worried the market's going to fall.
Yeah.
So where do we want to start?
Well, I think we've got to commend your current position at 24 years old. Solid start, no HEX debt, and you're still invested 40% of your cash.
Yeah.
So you can't complain with that. But I do think for me, the second part is probably, I guess, longer term more detrimental than the first. And I think if you're paying attention to headlines, the headlines are going to be around year after year after year after year. And if you're not investing and you're trying to time it, you're just going to consistently miss out. I think he's actually, or she has actually noted as well, like, I feel like I've missed out on the gains. Markets are at all-time highs. Yeah, markets are at all-time highs because they keep on ripping.
Well, you have missed out on the gains. Like, the fact that you've submitted it as a confession as well, like, I think, like, you're 24, you have 150 grand in liquid net wealth, and you've started investing. Like, you're doing a lot right. So don't be too hard on yourself would be a starting point.
Yeah.
And you realize that the feeling that you've missed out on the gains is the right feeling to have. That's your subconscious telling you, with your brain telling you probably should have been investing.
Yeah.
So listen to it.
And I think the view on investing has been clouded by perhaps being overweight and long. And
you're beating around the bush here. Your view on investing has been coloured by your investing choices.
Yes, thank you. Investing in lithium and losing 90% is going to make you question the long term. Well, going to make you question the risk of investing. But I can say that there are plenty of ways that you could deploy the 60% cash that you have that is going to be low risk. Much lower risk than going into a lithium investment and give you that sense of euphoria over a long period of time, just like you get from looking at your bank account and seeing all your cash. Can guarantee that if you're in a well-diversified ETF and in 5 years' time you're looking at that 60% in there, you're going to start feeling pretty good. Yeah.
We've been investing long enough now that we can start seeing, like, the gap between the amount we've invested and our portfolio is like you start to see that divergence. You see it on the compound money calculator, the Money Smart calculator.
It's true.
Yeah, once you start to see like the power of compounding, it beats the feeling of having money in a high interest savings account.
Absolutely.
And so I think it's like you've just got to, like, you've been investing for 4 or 5 years. Like, that's great. Just keep dollar cost averaging. Do an amount that's like psychologically comfortable for you. You don't have to put the full 60% in if you don't want to, but just know that, like, over time that fear will subside as you go through market cycles and you see your portfolio grow over time.
And my final takeaway is to remove the emotion away from it and automate as much of that investing process as possible, so you don't even have to think about the markets being too hot, in inverted commas. Just get the money in there.
And well done. Like, you're doing great.
Yeah.
So don't be too hard on yourself.
That's it. No hex debt. That's solid. Well, thank you to Soph for reading them. If you would like Soph to read out your confession anonymously, or if you would like to submit yours in a voice note and have it played on the show, head to equitymates.com/contact. We would love to hear from you. The audience, the Equity Mates community, learn a lot from the confessions that come in. But that does bring us to the end of today's episode. If you really enjoyed today's episode, or you take a lot of value out of what we do, we would really appreciate it if you could leave a rating and a review in your podcast app. But Ren, we'll pick it up next episode.
We will, with your portfolio reveal. As we touched on at the top of this episode, the Facebook discussion group has been calling for it. And next episode, I don't know why we didn't do it this episode, but you wanted an extra week to maybe trim a few positions, tidy it up a little bit. But make sure you're tuned in to Monday's episode of Equity Mates, where Bryce reveals it all.
Love it. Can't wait.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.